The Dow just logged the worst week since 2023. The bonds market is flashing a recession sign, and Fed Williams says now is the time to cut. So what's really going on in the markets right now? And as investors and traders, what should we be doing next? Well, we know we're in the worst month of the year, September. But as FundStrat's Tom Lee says, maybe we're front loading the sell. Today, we'll talk about everything that's going on in the markets, including some of the biggest transactions that have gone through over the last 24 hours. In particular, some in the best stock in the world, NVDA. Let's go through stocks, commodities, and cryptos for the week ahead in our special weekend report. It's going to be a good one. See you on the other side. Well, welcome back everyone to the special weekend edition of The Daily Show. My name's Tom, and today, of course, we need to talk about the sea of red because semiconductors continued to fall and the market was just absolutely getting pummeled during Friday. Will it continue though? Well, we've got some big data to go through in today's session along with some key levels, but let's talk jobs numbers to start off with. And it looks like the jobs numbers are starting to soften. Manufacturing was down, retail trade also saw losses, and most of the gains came from three major sectors: private education and health services, leisure and hospitality, and of course, government jobs. So, how bad is it? Well, it's kind of just like what you would expect, really. Yes, the Federal Reserve will have to do rate cuts. The question is, of course, how many, which we'll talk about in a moment. And the economy is obviously weakening. But are we in negative jobs? Well, the answer is no. And I think that it does always come back to this, as we'll see when I talk about FundStrat Tom Lee's comments on the jobs numbers. Realistically, I do align in some ways. It's not diabolical yet. And I think that's the key point here. Speaking of what the market thinks though, well, the market is totally freaking out in some ways. They have now changed in terms of the percentage stats of target rate probability cuts for the 18th of September Fed meeting from 25 basis points to realistically all the way into 50 basis points. And I'm pretty sure if I updated this after the Friday close, this was actually taken after non-farms, that it would probably be over 50% now, believing that a 50 basis point cut is needed. Now, as we've talked about before, 50 basis points, that could be the Fed starting to panic. And you can see here that the market certainly is when it comes to convexity and structure. Basically, the Fed fund rate futures have just hit a new terminal low. We are moving off the axis. We're going back into the twos potentially here when it comes to how many cuts we're going to need over the next 12 months. And it's expected that we're going to go all the way from this 5% plus down to potentially 2.75 or possibly, who knows, even lower in the end. Now, this is a big change from all of the previous months, and you'll notice that this really is starting to say that the market feels like it needs support from the economy. I also want to just remind everybody that, of course, we are in the worst month of the year. Here are the last 4 Septembers with big red arrows. And, of course, you'll notice that every single one of those Septembers was negative. The question is, are we front-loading these September sells? Well, let's take a look at put-call ratios. Now, we do have another put-call ratio chart coming up later on. And as you guys know, I love looking at it from an extreme perspective. That is when everybody buys puts and it becomes too high, there are too many puts in the system versus calls, we have to consider that that could be the low in the markets. Now, when we're only looking at equity-only put-call ratio, take a look at this ratio here. It jumped straight back above the 0.95, and this is exactly where we found ourselves in that panic mode only a few weeks ago. So will we see a bounce at these points? Well, there are some signs that that could happen, but as we often say on the channel, patience, react, don't predict. We did hit some massive key levels. We actually saw no bid on one of the levels I thought we would see bid on. And that means that we now have market structure to help us define when when the momentum comes back in. For now, bears are, of course, in control of these markets. Some other worrying signs that you'll hear about throughout the internet are, of course, the 10-2-year Treasury, one of the most well-known recession indicators, going back through, and it's pretty much official now. We closed the weekly in terms of inversion, and we've ended a 783-day pretty much uninversion spike. So this is the longest on record, and it means that we now are on a timer. Usually this is a fairly good indicator, but it does take time. We kind of worked out in our previous video that on average it would take around 6 months. It could take even upwards of a year before a recession actually plays out in the markets from an indication like this. And what this means as an investor, as a trader, is you want to be starting to think about what your long-term portfolio looks like. We've talked for a while now about utilities. We'll see in a moment that utilities absolutely smashing it. We've also talked for a long time about gold. Guess what? Gold's been doing very well and still held up over the last 24 hours. This is the type of thing that you want to be thinking about when it comes to late cycle. It's about capital preservation, because eventually we will get what we call a hard landing. And hard landings are not fun. Hard landings mean that markets could drop as much as 50% or even more. But is that right now? Well, of course, the case for the hard landing versus the soft landing, this will be a huge discussion. What I would like to see is, of course, I'd like to see the Federal Reserve do rate cuts, markets to effectively strengthen off. And what are we looking for? We're looking for the celebration. I want to see people in the market saying that we've achieved a soft landing. Look how well we've done. It's fantastic. At that point, yeah, usually it's a hard landing just around the corner. So let's quickly read here while you have a look at this chart on hard landing versus soft landing, some of Fundstrat Tom Lee's comments here. Bottom line, he says, even if we are cautious about the next 8 weeks, being, of course, the period of seasonal weakness into usually the US election, to us, stocks are at the lower end of the range and we see more upside than downside. Now, they also say we will not be sellers here. We did expect stocks to rebound on today's report, being the jobs report. And while we are disappointed this did not happen, it doesn't mean that we believe September should be cutting over 4% from the market decline. Some things that they are looking for, of course, is whether we're front-loading seasonal weakness, which is, of course, a discussion we'll have in a moment. And they don't really see any reason to markets to be bearish. I also believe that you'll need to be looking at the VIX a little bit here, and we'll talk about that in a moment. So let's look at the numbers. By the numbers, these are where the markets are now updated to, and you'll notice that things are starting to get a little bit better when it comes to valuations, although still, of course, valuations are super high. Where was the market moving, though, during the month of August and therefore continuing to move in September? Well, as we've talked about, financials doing quite well. Not really a sign of a recession on the cards. We've also seen REITs do very well. Again, not a recession on the cards. But one of the sectors we've talked about a lot, look at utilities, is still on everyone's horizon and list. And of course, one of the reasons I believe it's so good is it does incredibly well off this whole AI/cryptocurrency electricity demand kind of structure. You can see there that it's improving across the way. When we look at Bank of America and other kind of reports, including the Goldman Sachs one here, I'm noticing a pretty common trend. They're starting to put healthcare in, they're starting to put utilities in big time, and they're continuing to keep infotech. So if you have a look at the weighting here, take a look at their weightings overall. And if you look at the S&P weighting, it's very unusual for usually funds to be in utilities. Look at this, 3% of the S&P 500 is utilities, yet they are heavily overweighted when it comes to positioning. Also, we're seeing infotech, which is 30%, of course, being heavily weighted. But did you know that utilities has now overtaken infotech for the year? And it comes as probably no surprise to anyone that's been watching this channel for a while. Why? It's late cycle. We have to expect utilities to continue to beat the market itself. And I also want to kind of look here at some of the other sectors. Does that look like a recession when we see financials doing what they're doing? Probably not. Are we seeing a demand collapse? Probably. Materials and energy are both down. But you can see the stimulation coming into the markets through the sectors. And this is a great chart here because it kind of shows us that there is defensive style properties, healthcare, staples, and utilities, which are all increasing. But at the same time, we're also seeing some of the things that would usually be based on liquidity improvement, debt creation, and all of that stuff coming through. Also notable, consumer discretionary, while not beating out staples, is actually improving across the board. And this is not usually what you would see into a recession. For now, okay? For now. And I just repeat that because I think it's very important that you have to be able to look past things. It seems freaky when you get a sell-off like we just saw this week. It's absolutely terrifying for many people, and it's very easy to fall into the trap of being completely freaked out. But you've got to remember that this is what happens traditionally when the Federal Reserve cut. And of course, it will matter how much they cut, the percentage they cut. We'll look at that in a moment. 5 days later, 10 days later, 21 days later, all the way into 252 days later. This is from Grant Hawkridge over on X, and you can see here that there actually are quite a lot of positive stats when it comes to the cut itself. It can get a bit shaky at the start, but it does tend to do well past that. And you'll notice here fast cycle cuts versus slow cycle cuts. Slow cycle cuts have a much better chance of being a positive market action. I think this is an awesome chart. I commend Grant for this because it's a great visual representation of what happens when the Fed does a slow cut versus the Fed freaking out. And you'll notice there are way more on the negative side when the Fed freaks out and does a 50 basis point cut and continues to cut very quickly. So remember this, BlackRock have also come out, many other people have come out and said, well, if the Fed start cutting really heavily, maybe that's not so good. Yeah, of course it isn't. If they're cutting and they're freaking out, then of course market structure is going to show that same thing. You also need to just kind of keep in mind here, when we're looking at all these dates, how the markets are reacting. It's not unusual to see markets sell into the first cut. We've spoken about this before. We call it more of a kangaroo style market, which is very appropriate considering I'm from Australia. The kangaroo market that comes into the first rate cut. And often there's flash crashes, pickups, drops, similar things to what we've seen, sometimes a bit of weakness afterwards, and then the market makes a decision. Now, some of the ones that we're looking at in particular, of course, are 2019, and we've talked a lot about 1998. We believe these are two rate cut periods that could specifically be similar to the current situation that we're in. Late cycle cuts, the beginning of trying to create soft landings and different narratives, and the markets did end up going positive over those periods. Of course, both ended up in recessions. And I think that's important to note. Now, why could that happen? Well, take a look at this overlay. If you haven't seen this chart, definitely take a picture of this one. It's the 1970s inflation problem versus the 2020s inflation problem. And it looks like we've beaten it. But of course, if we're adding liquidity to the system, if central banks are starting to become supportive of the economy and trying to climb that wall of worry and fix everything, then what's going to happen? There's a real chance that we cause reinflation. I actually did a poll from you guys recently, and most of you believe that inflation hasn't been beaten. But of course, this is what the chart may look like. So we may see a spike. Funnily enough, this week coming, we're starting to see the CPI reads. We're right around where we should bottom in CPI. So maybe it's this one that we bottom, and then the next one actually might start to see an uptick, even though we're starting a rate cut cycle. This will be one of the biggest dangers. And of course, it's going to be very interesting because remember, we talked about the idea that we're going to say we beat inflation. Well, let's say we get a bit of an uptick and then we sit like we did for an entire year in 2025. What is going to happen in the news articles? Soft landing, we did it, we fixed the economy. Boom, oh, that's not good. Now, of course, we don't know this is exactly what's going to play out, but my point is it's a good chance that a similar situation may be occurring. Let's have a look at the average S&P 500 path in election years that did not end in a recession to, of course, election years when you consider everything that end in recession as well. I think it's just important to note that while we're not following this convecture anymore, what's really going on here is, of course, different data presents a totally different chart. I guess I just wanted to bring that up. Global liquidity is increasing. We do need to remember central bankers and governments around the world are working overtime. And just like when it comes to the market and September being bad, that is the same thing for Bitcoin. So I thought I'd bring this up before we look at dark pool liquidity because October is a best month of the year for cryptos. Now, cryptos are getting crippled and there are no signs of recovery yet on the Bitcoin market. We are bullish on it when you're talking about longer term. So if you're talking multi-months, then of course I'm bullish on it. Why? Well, look at this chart, October, November, December. What happens over that period tends to be bullish. So again, we were looking for the price action and of course we're looking for the structure. So I thought I'd include this chart just to kind of bring things back to perspective. Yes, we've sold off a little bit here, but you've got to remember when we've had January, September up on the S&P, the absolute returns for the rest of the year are generally bullish, 91.67% of the time. That's actually quite a big stat. Let's now talk dark pool liquidity here for a moment because there are a couple of large traders coming in and dabbling in NVIDIA. I noticed this throughout the Friday move, and this is good news for NVIDIA traders because what's happening here is we know we've got puts all over the place. I mean, we're in negative gamma. We're sitting on a puts fest. We'll look at that in just a few moments. But we also know that somebody is transacting down here. And notice that no one transacted between this range. So effectively this range, and you can see over here, were not areas that big funds were wanting to purchase. They did want to sell up here. So that's, of course, selling into us retail traders. We've talked about that on the channel. And it looks like they could be placing some buys down here. Now, how are we going to confirm that buy? We're going to want to see the V. We're going to want to see the recovery on the right side. If you're somebody that bought 105, 106, one of the key levels we spoke about this week, I wouldn't necessarily be terrified because guess what? Someone in the dark pool liquidity, they also bought that price. But you will want to see recovery. And this is why we talk about scale-ins when it comes to these prices. We'll look at this soon. What about for the day into the 5-day trades? Well, we saw mostly defensive action this week. Staples, the REITs still out there, utilities. But I think the most notable thing for me is always to look at that financial aspect as well and home builders. And realistically, financials and home builders, while they were down, they were not in the dirt. It was semiconductors, it was materials, it was even gold stock. That wasn't really a sign of, I guess you would say, a huge sell-off in terms of the market freaking out and being in a full recession. When we have a look at the Friday trade, home builders was number 1, REITs was number 2. Again, staples, healthcare, utilities down the least. Again, it's not really necessarily a market that you've got to be freaking out about completely. Let's now have a look at the gap fills, because one thing was for sure, I actually expected 54.30 to 54.50 to find a bid. And there were no bids. Now, post non-farm payrolls, specifically what we were looking for is to go above 55.50. If that had happened, I would have been bullish. I, in fact, would have been probably purchasing a bit of the V shape. And this is the big thing here. You've got to have patience when it comes to a replicable trade or investment, and you have to see the reaction. Now, the initial reaction to non-farm payrolls was to rally the market, and then, of course, they dumped into this area here. Now, there were a few levels that you may have had a bit of a nibble at. Of course, if you nibbled at around that 54.50, I don't think it's the worst price in the world. It's a decent position or buy the dip style zone. But now that we broke through that, can we go lower? Can we go all the way to 53.42, the second gap fill? Well, of course, this is really the question of the week. And I think options are probably going to help us to define that. But just a quick update for Monday, these are the option level highs and lows. You'll notice the low comes in right around that gap fill, which is important. And we're still not even at a 61.8 pullback of that rally. So you've got to kind of put things in perspective. The NASDAQ looks pretty bad, but the S&P actually is not that bad. Although it's pulling back and looks kind of negative and everything, it's not absolutely shocking yet on the charts. And this is something to keep in mind when you're checking it out. Now, because it closed on the low, it suggests there's further selling to happen in the futures. And it suggests that there's a real possibility the second gap will be filled. So let's have a look at the S&P options market, because we did see negative gamma take hold. The put walls ended up turning into full negative gamma, where effectively what happens is the markets fall through those zones, creating a forced hedging effect. And that ends up, of course, leading into these waterfall style events. Now, 5,400 now remains as a big put wall for Monday. So you'll notice 5,400 and all of a sudden 53.50. So these are the two major key levels. Now, we mentioned PCC before. That is put call ratio on the equity side. We'll look at the other one in a moment. But when we have put call ratio that high, it's starting to suggest that the market is stacking so many puts that you have to consider a relief bounce. So if we do manage to get down to the second gap, in particular for the S&P, you've got to consider that the markets are probably becoming oversold and that a relief rally at least should be coming through. Again, if we see signs in something like NVDA breaking through those highs and showing that V, it's probably a good sign that, yes, okay, the worst is behind us for now. But we are in negative gamma. You've got to be aware of this. The markets are currently in free fall. And once you're in free fall, you really do need to see the V-shaped turn, or you've got to know what you're doing. You've got to be very well prepared for the fact that markets may go lower. Let's say, again, you bought gap 1 on the S&P. Good work for you to be patient enough to wait for that level, by the way. But of course, it fell through further. You have to expect that is a possibility. And we actually saw a lot of synchronization between the S&P 500, the NASDAQ, and the Russell all at the same time. And I love sync. So when we saw that synchronization, to me, there were actually quite a few markets that were all pointing towards, you know what, this is not a bad chance at finding a good price. And you've got to kind of look at your stats and keep playing that stat game so that you can replicate. Remember, 40 reps is the key. All right, let's have a look at all expirations when it comes to the S&P. I thought I'd include this chart this week just so you guys can see how stacked 5,400 is. And of course, we have a huge amount of stacking going on now. So this means that for September, for October, we have just tons of puts all over the place sitting around these levels. And that will help to support the markets in an oversold situation. Remember, Tom Lee believes, I don't see the fundamentals justifying a 4% decline in the first week of September. Now, he could be wrong. He's been pretty right the last couple of years. But I do tend to agree, if we're in late cycle, we still should be able to climb the wall of worry. The Federal Reserve is coming in with the beginning of bazookas. It doesn't look like a normal recessionary kind of stim. The market is weakening. The economy is weakening. But do we have negative jobs growth? If the answer was yes, okay, we can be way more terrified. We don't. So I think that's important. We just have a lot of revisions that keep bringing us down to lesser numbers. S&P versus CTAs. You'll notice here CTAs both dropped positions this week in NASDAQ and S&P, but Goldman Sachs, Bank of America, and other models are all suggesting that CTAs do need to start buying the dip at some point here. Brent CTAs, again, if you look at oil, if you look at anything right now, most of the CTA positions are in the dirt. And this is something that, of course, we are also watching. We'll check that in a moment. Let's move over now to NVIDIA. So we know that NVIDIA had a lot of puts between 105 and 100. Well, this week coming, 100 and 105 are the key strikes again. So again, this is where if buying pressure is going to come in, it's going to come in around this zone. We saw a bunch of trades at 102 and at 105, 106 this week. So that basically means that if we start to recover, where could we recover to? 120 would be the logical target based on the current options levels. When we go over to Tesla, we hit, of course, 232. Things look a lot different now that we've, of course, had the non-farm payrolls. 200's where the big put wall is. We're trading at 210. It was a big sell-off for Tesla. And if you managed to take profit at 232, congrats on you. Of course, we just did discuss that, and we didn't manage to get the breakout from 232. If we'd done that, we probably would have been in what we call a head and shoulders, in this case an inverse head and shoulders, that could have pushed that positive gamma situation. But going from positive all the way back into negative gamma in just one session. Let's now move over to the charts. We'll look at the lead indicators here first. Uninversion, it's happened. That's it. That's locked. 0.983. It's not some weird love tap to it and then it just goes off. This is literally a closure, and we are now officially uninverted on the US 2-year versus 10-year. We're on a timer. We're in late cycle. It's how it is. Do remember, another one of the indicators that we often use on the charts is XLY versus XLP. And if you look at that from the weekly, you could argue we've been climbing the wall of worry in late cycle since July of 23. So of course, as we're on this timer, as we know we're in what we're in, you've got to just start thinking about the markets a little bit more differently. You've got to think of them a bit more defensive. If you're going to be in growth, be in the bubble kind of things, but be aware that it is a bubble and there will be sellers that eventually come in on these markets in a big way. You're already starting to see the volatility of NVIDIA, but imagine the real vol when something actually goes wrong. BCC, so this is taking into account equities plus indices when it comes to put-call ratios. You'll notice here the 1.15, we're not quite at the extreme, so we could still see more downward action. I'll update you guys if we manage to get into that 1-3 ratio. I really like the 1-3 ratio as a strong buy in markets traditionally with good key levels. Let's look at the US dollar. The US dollar was up, down, all around after the non-farms. You can see here the 2-hour action. When we go to the daily, it rejected the low. It might look kind of strong, but what this does is it gives you a line to put in the sand here down the bottom. If we close below that line, it's going to be free fall for the dollar. So the dollar did find bids because, of course, everyone was freaking out. The trend is still down, and do remember if that level is taken, might be worthwhile leaving on your charts. US oil didn't quite get to my watch reaction here, but it certainly got crippled down to 67, and then the market was finding a little bit of a rally. US oil is now in almost full oversold mode. Not quite there, but almost full oversold mode. We will continue to watch oil and, of course, be on top of it. But this just shows you again why you've got to be so patient. We say patience, react, don't predict. Heaps of people buying oil at 69 and 70 a barrel. Unfortunately, they probably lost their positions over the last 24 hours, and that's kind of the way it is. Copper, weaker than I would probably have hoped. This was a fairly decent replication. Needs to find buyers here. I actually bought some in this area and here because it looked pretty good. And there were two options. One, could have broken even it after non-farms and pretty much just kind of walked off. I'm still holding a bit because I think it's got some potential here. But copper, while it was less weak than maybe some of the other major markets, it still fell off. Like to see a bid on this over the next week. We'll keep watching it and see what happens. Let's move over to gold. Gold's still doing fairly well. Still in a pullback in time, which basically means a sideways market action. And you can see here that it's come back down and tested the daily 20 moving average, finding a buyer there near the end of the day. So gold's still holding up very, very well. It is overbought a little bit on higher time frames, so it makes sense to consolidate. But realistically, I'm still bullish it. Nothing much has changed on my opinions in gold, of course, over the next 12 months, 18 months, that kind of period. Silver did drop more than I'd like. So silver came back down to our key level, and you'll notice here it actually was nasty because it spiked just slightly below the low. Now, I expected it to get back to 28.20, and remember this line because 28.20 synergized incredibly well with the markets hitting key levels. The S&P hit underneath the put wall by a little bit. The NASDAQ hit the gap fill. The Russell 2000 hit 2080. And all of these levels were some of the key zones that we had in our kind of discussions over the last couple of videos. Now, that's really key because when you hit all of those, it usually is a pretty good sign that you're finding buy pressure. In this case, there was literally not one bid. We came down like a freight train, we kept selling, and then we find some bid into the end of the day. I'd still expect this to be a fairly strong level for silver, but we do need to consider now that the market closed weekly down into these levels, and the daily obviously just managed to reject a little bit of a wick. So we know they're buyers here. We already knew that anyway. And I would still say silver is more long than bearish, even though the price action might look kind of negative there. Tesla sold off back down to 210. We've already talked about this. First take profit target. A lot of people were looking for this area. If we ever do breach 232 in the future, I think it's going to be a very strong move for Tesla. So keep that one on the charts. For the week ahead, 200 is the major put support. NVDA, big trade into the end of the day. We know there are big trades around 105, 106, and we know that we need to regain 110 to be really showing that V-side momentum. And I like semiconductors and NVIDIA from this perspective. Okay, yeah, it's come down further. It's actually at a 75 fib right into this buy pressure. But if we take 228, worthwhile alerting yourself to, that's a super strong sign in the future. So yeah, okay, it's bad right now, but if we see bid and the bid comes up, and you might say, well, Tom, that's like 4% away from current price plus. It's what happens. You have to take the V. You've got to take the side that actually shows the momentum. At the moment, who's in control? It's bears all day. Would I sell here? Absolutely not. I would never sell at this level. If you sold on Friday down, congrats, not too bad. There are some replications there for sure. But to sell this level, oh, I don't think so. I don't think it's worth it. There's the risk reward, considering the levels. It's just not a great idea. HSI will obviously open up down, you would believe, on next week's trade. We'll see how that ends up. We're looking for markets to get above 17.57, but realistically, it's holding a lot better than the American market at this stage. Speaking of American markets, let's have a look at the Russell 2000. Freight trains into the most traded zone, 2080. Like this level, actually. No bid here, but I do like it. So I would like to see a buyer and a dark pool transaction or something like that. We will track. I'm eagle-eyed this week. There's big opportunity here. So we're going to be watching. And if we see it, well, we'll report it here on the channel. So make sure to subscribe. Let's move over to the Qs. Second gap fill achieved. Market goes lower, hits into the 61.8. This is a pretty good zone for people that are bullish on the NASDAQ. This is the area, you know. Do we have a bid? No. Do we know where we see a big turn? Yeah, above here, 465. That's going to be a huge turn. probably push a new all-time high in the market. So this is a significant point here. We saw the big move from non-farm payrolls. It looks like a complete sell-off. Everyone's going to be saying September is going to be a bloodbath. Everything's terrible. We know that kangaroo-style market into Fed cuts is pretty common. We know that the VIX complexity, kind of like when you looked at it, convexity, that was actually already showing that there'd be increased vol, and we're seeing that kind of vol play out. A second vol spike is normal. Usually this happens every single time you see kind of that what we had in August. So around this point, very interested. Could go lower. Of course, it is possible to go down to 435 as well. We'll continue to maintain. No sign of bid though. Small time frames, no buying or anything. RSP, again, equal weight, no signs of buying either. So whether it's the Dow, whether it's the RSP, whether it's any of these things, everything was dropping. And I'll put in for the Australian viewers out there, just so you guys can see it. I know I get a lot of questions about this, that you've got to remember, even the Australian market, it's actually quite strong because of the financial side. Again, this just shows you this is not the sign usually of a recession. The world markets are actually still holding up relatively well. It's because it's tech-based. This is a tech sell-off across the board, semiconductors particularly. Most traded zone, if we hit a 7,800 this week on the Aussie market, around that area is going to be where you expect buys. So there's a lot of synergistic harmony throughout all of these markets. And I'm sure if you put in something like the UK 100, not that I have, but we'll do it here live. Let's have a look at the UK 100. Yeah, that makes sense. Hitting around 8,100 would be around that area that you would see usually a buy come in. It's the bottoming line. We've hit that res a lot of times. We're coming back down into this key area. And I would probably say if you pull the volume profile through this whole thing, around here would be your most traded zone. I guess we can do it. Let's do it together. Let's chuck one through this area here. Yeah, so around in here all the way down to here. So they're actually equal, I would say. So yeah, 8150, 8100, anything in here is where you're going to be getting that val low and most traded area. So it's important to really consider this because markets are all hitting these key zones at the same time. Do we find a bid? We don't know that yet, but the sell-off has been larger than most people would suspect considering all of those great breadth indications and all those other things. And you might say it's the end of the world. I don't think it is yet. Let's have a look at Bitcoin. Bitcoin closes right on the 54K support. There's no bid. The market sucks at the moment in crypto, guys, but it's well known to suck. So we've kind of warned against September. We know that September's crappy. I am bullish on Bitcoin. I really think Bitcoin should be doing better than it is, considering how bullish we are in gold and how well gold's done for us for the year. If Bitcoin is even as good as all you guys say it is, or a lot of you say it is, it has to start performing October, November, December this year. Late cycle, it should be doing better. We should be seeing kind of 65, 68 right now. We're not seeing those numbers. So once we eventually get bid, I'm pretty sure Bitcoin will do well. We will be watching for bid. There are no bids. We are at what a position-based or a buy-the-dip person would say is a good level, but there are no signs of incredible strength just yet. So, of course, we're looking for that 60,000 to be closed above, and then 65, and then 68. And once we get 68, we should be going to an all-time high, et cetera, et cetera. Now, you could say it's a risk-on asset. It's just trading with the NASDAQ. Yeah, there's a lot of different options there. Let's have a quick look at Ethereum, also falling heavily. And you'll notice I've got bull zone 2. This was one of my original buy areas for Ethereum. We're back down to the same level. So we'll find out whether it can get a buyer again. Let's have a look at the news for the week. 8:30 a.m. New York time. Core CPI. CPI coming through. We do know that this is going to be an important factor. Of course, have we beaten inflation? Could count. I think it'll probably drop. Hopefully it will, because that will then really feed into what we know is probably going to happen once they do a rate cut in the US. PPI then coming out on Thursday, so this is also another important factor. And this week will be really pretty much defined by CPI and PPI. Once we get those numbers coming through, particularly the CPI, I think we're going to see large moves on the markets, and whether we might even drop into, of course, some of those other gap fills we discussed. Make sure to subscribe to the channel this week, guys. It's a lot of important information coming out. More importantly, important key levels that are super defining to this market. And over the next 1 to 3 months, we're going to find out everything we need to know about structure. So are we concerned? Well, not really. I mean, it's the pullback you really want to have after going up like an absolute freight train. You're coming down in the elevator at this point. The markets look really nasty, but at the same time, we're starting to see things hitting key levels, and that's really important. Make sure to sign up as well if you're interested in checking us out on X, because I will be posting pretty much charts every day for the S&P and NASDAQ, as we like to do when we hit key levels. And of course, if you're interested in finding out more about replication trades, how to be patient, how to react, how not to necessarily predict unless it's a cyclical overlay, why we've been so strong on utilities, why we've been so strong on gold, and how they've been working out. It's all in those courses, particularly the advanced. I'm telling you, it'll absolutely change the way you look at markets and the Ponzi scheme of what we're actually trading all the time. Bye for now. You have a great weekend, and hopefully you manage to stay out of trouble this week.